And I'm certain that we'll get into details later, but I recall that the reorganization provisions of the Internal Revenue Code permit certain transactions to occur without the recognition of gain or loss. That's a powerful incentive to plan how transactions are structured, right?
Well, Mike, I guess I'm going to sound like a broken record with a yes and a no. So on the one hand, the ability to structure a transaction on a tax-free basis is appealing, but I will say in my experience, which as you can see is fairly lengthy, we start with a package of consideration in a deal that is not governed by tax. Somebody, the finance people, the others, the business people indicate we're doing a stock deal, we're doing a cash deal. And by the way, the overwhelming majority of transactions are cash. So we're not going to use the reorganizations or reorganization rules. On the other hand, when there is stock in the deal, we certainly need to roll up our sleeves and make sure we're working with the tax-free reorganization provisions. And there's virtually always a provision that we can fit into to make the stock tax-free. So having said that, Mike, I would say one situation where the tax people are going to say, no, you got to use stock, is after a spinoff, a tax-free spinoff, there are rules that would be violated if a close in time subsequent M&A transaction were for cash consideration. What often happens in connection with a divestiture, if it's substantial enough, is we may be on a dual track where we're going to be in an M&A process looking to sell it, but also looking at the possibility of doing a tax-free spin-off to the shareholders, or possibly even a combination with a spin-off coupled with a permissible type acquisition. So lots to be done, and you don't want to let it wait.